speculative growth. There are companies that can maybe be very huge, and by the time it's very huge, it's going to be incredibly valuable, right? So it's a unicorn. It's really a unicorn, but there's still that chance, whether you're dreaming or not, and you have to like snap out of it when it's a fantasy and not real, right? It's a unicorn because of the fantasy, right? But if it turns out to be real, it's going to be, change the world. It's going to do amazing things. It's going to be extremely valuable because they have a unique product. These are businesses not because of what it's doing, but because of its product service value solely, not from what it wants to do per se. What companies that look for companies that are saying that they want to do something and that they look that they're going to likely do it mostly, almost, but they aren't beginning or starting to do it as much. Those are companies, those are turnaround companies when they say they're going to eventually. These are companies that are already doing it and already establishing a bit, right? So by this nature, these are companies that a lot of people can either be mentioning a lot or not even mentioning at all in the world. So the thing about this is that it's a hit or miss game, right? These companies look very, very promising by the incredible value you see in their product or service, but maybe they're restricted to usage, not being seen yet from the customer, or not realizing hidden value yet within their new products or their existing products that could be highly used, right? Most of all, the new products they will get. Sometimes this can occur in a relatively new industry like AI, for example. So it's only a matter of time that they do, that the customer does get the product, because that's what the product is so valuable that you don't even care if people don't see it yet. It will catch on a year or 2 years later. In another circumstance, it's a fantastic product or service that it's very unlikely it won't make more money. It's just probably a fairly new company that hasn't made any net income yet, but it certainly will very soon. These are companies that could really be on any sector or industry, but by its nature, you might find it probably more on technology. But to be honest, they exist on all sectors. You can find unicorns on all sectors. Always invest though in what you understand, not in things you feel you understand because others tell you how important they are and that you should get in on this. No, don't do that. Rather, you want to understand things because you yourself sees that you completely see the value in the company from the due diligence you made, from studying the company down and up, studying where it lives, what's its neighborhood, who, where, and what does it like to hang out with, when it goes to the bathroom, what's its competition, its biggest rivals or nemesis, if it has one, and how does that either affect positively or negatively the business. You're really spying on the business as you know exactly when it eats, sleep, drink, and like to watch, right? So you're really a stalker of the business, and that's what it takes to know. Really, that's the way how I look at business. I look at business like if I was a spy. I look at everything, absolutely everything I can possibly think of. If I have like a thought, okay, let me search that up. What about this? Okay, the profits were down. Okay, why? Let me search on the SEC.gov. Okay, let me see exactly what they're doing here. Okay, they mentioned this on the certain industry. Who else is doing that? What is making up this entire value? Oh, they said a word I don't understand from technology. Let me search that up. You have to do everything, right? So whether you have a good investment, because that's how you know you have a good investment. Now, it doesn't mean you have to know exactly what it's going to do every single time, even afterwards you invested into it, because that wouldn't make it a good investment. That's not the simplicity of investing. The whole point of this is that you do all this due diligence at first, so you don't have to continue doing it at later because you already invested the business like that. That's the type of way that I invest and that I'm going to teach you how to invest. I'm not teaching you to invest in a company and you have to manage it and try to change it. No, I invest in a company as it is. I don't do anything, and I just leave them how it is, and I trust them to manage the business. So that's the whole point. That's how sure I am. And I really recommend you do the same way. It's going to be a better investment, a mature investment, a simple one. Usually the simplest investments tend to be the best investments. You don't always have to know what it's doing all the time because that wouldn't make it a good investment, but what it's currently doing is sure to secure its future without looking at any earnings, what it will do, or ratios, or nothing else besides the pure business itself and what it's selling, right? Earnings are stupid when people get affected by it because look at Apple. Does Apple really think highly and so important whether their quarter earnings are going to be great than the last? Not at all. When they make a decision in their company, they're looking for the long term of 3 years because they're more focused on their customer. They're not focused on what people think and on the short term and that they adjusted their cash short and that's a bit risk because they have their cash low. None of that matters if they're putting that cash back to the product. That's for the long term gain. So you see, I never invest, but I invest in the long term from the business, not from the stock. I'm a business picker, not a stock picker. So by this, you see which negatives or positives it outweighs the next. And by a significant margin, you can see it be positive. You can see it as a potential investment with promising returns. So here's a pretty funny example. This is a company starting to scrape a bit by almost breaking even, and net income was $300 million loss right now, right? They're losing about $300 million and Wall Street doesn't care. Then 3 years later, now they're making about $5 billion in net income when sales 3 years ago were $1.9 billion. And the income 3 years ago, net income was $300 million of a loss. And 5 years before, basically 2 years before of this loss, since its IPO, it was actually losing $1.1 billion. So yeah, Wall Street's definitely shocked. Those are basically speculative growth companies. All right, now we're going to talk about turnarounds. These are businesses that have virtually no record or name to themselves, but you see the huge potential from the products or services they sell or are beginning to sell. You find a business so promising, so much potential from a phenomenal product that can provide enormous value to customers, but you see that no matter how amazing the product or service is, the company has a few problems. Their sales are decreasing for quite a period of time. It's a very new company that was founded actually maybe a little bit less than 5 years ago, so 4 years ago, and they went public, let's say 6 months ago. And you see that this business too has a high amount of debt compared to their cash. But nonetheless, you believe in the product and service value of the business so much, or the business has a great product and service and remarkable management in the company, that you still want to invest in it because you see more of the potential returns can outdo the possible high risk. In somewhat, the odds are against you, but you still believe that in overall their products or services are so great, so underlooked, but just great in total that you could see a lot of people consuming it through the industry. Not from hope, not that you could heard it from something else, but you saw the practical value of the product, from the uniqueness that the business can become very profitable very soon. Now, this along with speculative growth companies are going to be the lowest allocation type businesses you will invest in from the higher risk they carry. So a good example that I like to look at from these companies that it just reminds me of is that an asteroid situation again. Let's say an asteroid was breaking through the atmosphere, right? And there's a group of scientists that saw this asteroid a day ago and they knew they would hit it, right? But they wouldn't be able to impact the asteroid as much if it didn't go through the atmosphere. So now they're deciding to set a big nuclear missile to charge to this asteroid that's the size of, let's say that it's the size of Cuba. But the scientists are really saying like, okay, this is either a really good idea or it's a really bad idea. Because if the nuke somehow misses and deviates off the track and somehow projects with momentum back to the Earth, we would have accidentally provided insurance to the asteroid, right? So the asteroid, of course, like it's now the demise, the sure demise, but what secured the demise was the weapon to stop it, right? So it's kind of ironic, but that's the same way how I look about businesses. It's either a really good idea or it's a really bad idea. And that's why I don't invest in much of them. Because remember what I told you, 98% of everyone tends to not be extremely ambitious to change a lot of things from the industry. Because that requires a very unique person, to just strive through and change the industry to work all day. But these type of people are very low because out of itself, 99% of everyone in the world does not want to live uncomfortably, does not want to strive for huge success because they don't like failure, does not like to remain themselves extremely productive because people like to do what everyone else is doing. So you see, by this nature, it's very hard for a certain company to come up like this, right? But when it does come up, but you're so sure, then it's the time to invest into that. But it's still a big risk like this nuke. All right, now dividends. So a business that usually dividends, there are businesses that usually pay you a high interest per quarter just for staying with them. Essentially, these are reoccurring, I like to call them reoccurring cash incubators, because they're just paying you for just looking at them. Like they're literally giving you money out in front by staying with them. So they're really incubators for cash in a way. But I don't do this for a lot of companies. I do this for very, very, very unique few companies, right? These companies are very strong, sustainable companies that offer good dividend yields. So these will be strong, solid companies that are predictable, of course, and have a strong product or service in what they offer and almost have no competition or are dominating and yet pay relatively high dividend yields compared to normal companies. These businesses will be really a predictable business that you see easily. It can make money continuously so in the future. And yet it's very hard for something or someone to disrupt their products or services, which can disrupt later on their profits and fun, hence disrupting the business. But all potential disruptions are a very, very hard chance to happen for a fantastic business. After this, you can overall find whether it pays high dividends. Now, it's a red flag if they pay too much of a high dividend, because net in total, look, dividends are liabilities for a company. They need to pay it out somehow for their investors, and they're not going to just get the cash out of nowhere. They're going to get the cash out of their own income. And when it's too high relative to what the share price is, like if it's 20%, that's a red flag, because how are they able to sustain that? So how can they physically pay you such a high interest if something is going on in their sole products or operations, or they're losing a lot of market share from some other company? So you need to look for a business that has a good dividend yield, but not too high, or else it becomes counterproductive and dangerous to the company, right? And there's no excuse for this. No matter how great a company is, if the dividends are too high, no matter how good their products are, it's still very dangerous, because this is like a debt. It's a good debt because you're incentivizing more people to buy your stock. This is a risky thing if you put too much payments of a high dividend yield, because that's going to suppress. It's like capital expenditures. It's going to suppress the amount of net income you will make more. It's the same thing as capital expenditures too. It's going to suppress the amount of cash flow you can make more, right? It's going to suppress the amount of funds you'll have to make more innovative products, more better products in total. So it's counterproductive when it's too high. That's why I look for very strong businesses that are able to pay still a good dividend yield, but not too high. You want to keep watch of many so-called high dividend yields, because these businesses mostly tend to be pyramid schemes, and many people fall in those traps, and they keep reinvesting more money when there's virtually no evidence or common sense from your study, not from others, not because you were in a group chat and someone told you that this company is going to do this and whatever, and they're paying like 20% of the dividends, and invest in it now and keep investing because it will do better. That's not investing. That's gambling. That's complete gambling, and that's not what we do here. And that's not what you should do, right? If you find one of those companies, you want to run away, right? Because how in the world is a business going to make more money, or is even making money in the first place, right? You never want to invest in a business like that. If there's no evidence or common sense that you see that the business can make more money, you find no evidence of even how it's even making money now, how it's staying alive, that's super risky. You shouldn't invest in that. And you actually, if you do invest in it and you lose, you deserve it, because it was a bad investment in the first place. So the best way to go about life that I recommend you guys to do is you want to deserve what you want, right? That's the best way. So you only invest in ones, with a very high accuracy, you see clearly it can make easily more money in the future. So I like to look at it like this. Think about it like if this was the corporation or business, right? And this is the queen, which is the business as well. It's the payer. This knight is you as a shareholder. They give you a pile of gold, right? And you both exchange on that. You're both happy, and you're getting paid greatly per quarter for owning part of the kingdom. These are essentially the dividends you're being paid. It's like that. It's like that example. Okay, this is one of my favorite companies to invest into. Besides Predictable, this is one of my favorite as well. So Deep Value. These are deep, valuable companies. So it's a highly reputable brand that's been dominating even since before a 30-year-old was born. These are companies with such a long track record and a reputable name that a significant product or service and impact that and always have seen consumption of them, even when there was a great recession, right? These are essentially products that are always consumed on any event, whether there's a pandemic, a flood, a tornado, a recession, or even a depression or a world war, right? They're more of a need item that people cannot stop consuming or can't even think of not consuming, even when they're dead. These can be mixed as somewhat want items, but they're mostly core necessity items to people as something needed to have almost immediately when they run out, because they can't think once of not having it every few days, or that they actually can't even function without this essential item, that this essential item is keeping their normal standard life and happiness as they are, including everyone else's happiness and standards, to function in the real world from what they depend on to use or to consume. I look for all businesses that is more than 80% of this type of way, right? From the psychology or literal items that people will go nuts if they can't use for a day or a few days. These businesses will be on any sector or industry. So the complete value of a super high reputable brand are solely in the business, not in the industry. It's incredibly hard and would require a very, very intelligent person who wants to go against this type of business and try to take it down. But even so, if they pursued this mission, it will take them at least 20 years to make a bit of progress. But even then, they won't even make a big result moving this titan. But even so, the probabilities of some unique character to appear in the first place is a chance of less than 5% to happen. And chances of that person being successful is less than 1%. This is always going to be a running risk of buying very predictable companies. But even so, I know the odds are highly, highly in my favor. And still, and overall, the chances of someone to enter to challenge with an actual weapon to make a result, to make an actual result, is something of a chance that can only happen maybe twice a century, right? So I like to look at it at this. Look at this like if it was this huge company, right? And this is the person trying to challenge it. Oh shit. Like it's this terrifying giant that it would require a person who would give it all, right? It's a behemoth company. It's not that it's impossible, right? Because these companies inevitably will die. Every company will die eventually. It's a biology. That's how companies work. But these companies are like Titans and Godzilla. I mean, it's a company that is so easily seen that it will last for so long by a business standpoint that it's very hard for any smart person to take it down. And even if that smart person was smart, it requires them to be very unique, out more than smart, to do things that are very risky, to be bankrupt many, many times, to change consumer behavior. You literally have to change what these companies do. Why are they so powerful? Because they control the reins of consumer behavior, right? So it's very hard for a new person to give it all and go through bankruptcy a lot of the times to try to manipulate and control consumer behavior out from the Titan's hands. See how low of a chance that is? So these are behemoth companies that can only be taken down by a person who would risk everything, which would be a very low chance since 98% of the people in the world aren't striving for success in their life. And even more than 99% aren't as ambitious to put all their life's work in actual forefront big goal to take down this sensational monster brand. Even the ones that try give up easily by once every 2 centuries, give up easily. But as again, it's biology. I would say this isn't like a guarantee that happens all the time, but every once, I would say 2 centuries, there will be one unique person that's going to take it down. But only a person who has the clarity to push beyond failure as even part of what it takes, and to dedicate 20 hours and 7 days a week every day for years until they succeed through many bankruptcies, and to keep doing it as even part of what it takes as well. So you see, this is a very, very rare person to come up with these characteristics, and these type of people only come in maybe twice a century. One of these people is like Elon Musk, right? I highly admire Elon Musk. Elon Musk is I think in my eyes, he's really the best entrepreneur I've ever seen, and probably that there's ever been, because he goes beyond failure, right? And he's a very intelligent person, but he has a work ethic that hasn't been seen in dozens of decades, right? So that's why Elon has become so successful with cars, right? But even so, look at how he is, how successful he is, and he still isn't able to control or to become this enormous brand in the automotive industry. Why? Because the automotive industry still has titans, and still they're pretty hard. You see, it's very hard for a very unique individual like Elon Musk in himself to even get in another industry simultaneously too and try to take down another titan, if he hasn't even taken down the titan that he's been mostly pursuing since he started Tesla, right? And same with SpaceX. They're becoming one of the top echelon for sure, but he hasn't took down the top dog yet. So you see, it takes years, and it takes a unique person. All right, so now the other type of investments. So these are now ETFs and index investing. So this will comprise most of all an ETF tracking the S&P 500. This part is actually really simple. The best ETF for the S&P 500 right now is the VOO, which is Vanguard 500 Index Fund ETF. And that's just because they have the lowest expense ratio out of any index fund or ETF. To invest in the S&P 500, you can only do it through an index fund or ETF. So this is really the best. You'll get the benefits of holding the strongest companies in the world, in the US, similar to index investing for the long term, and maintain a strong performance hugely in the long term as well to outweigh any lacking sector or non-desirable possibility of a poor investment on one of the categories in the portfolio. This investment will help outweigh enormously too on your front to any overestimation you had, even though, look, I strongly completely advise you to have low expectations always, and looking very methodically before you invest in anything that you know, with a full confidence though, and surety that it will continue to make money and more money on by how amazing their products or services are. But in any case, this S&P 500 investment it's going to incredibly help you limit any folly on your end. So if you made a bad investment, that's fine. The S&P 500 area will help mitigate that in the long term, because the S&P will always go up as long as the economy is seen to go up, right, for the long term, which it is. As long as there's more companies making money, and there is. It hasn't been compromised at all. And that won't be the case until a very, very long time, until maybe I'm very old or maybe after I'm dead. So I like to look at it as this example in the picture. This is just a pig, right, sitting at night, and he thought today was pretty stressful. and a really tough day since a long time. But you know, then the next day in the morning, he realized that when the sun is up, as it always be, there will always be a tomorrow and a new day, and you'll be able to start from scratch. The sun really represents the S&P 500 as the hope for the next day allows you to continue to progress with things for sure, which is your returns, with a new start to always be there provided by the S&P 500 to make steady returns better, right? So that's why I keep saying this just helps limit the folly you will have, even though I'm trying to eliminate the folly you will have by teaching you how to fish and teaching you correctly. But inevitably, if there is a bad egg that you did, even though you cracked the egg, you saw everything, this investment in the S&P 500 will help limit that folly in the long term, as it will give you a guaranteed return. We've now summed up pretty much the general and most effective way to build a diversified portfolio.